Hello everybody, thank you so much for joining. Just double checking you can all hear me, and then we will get started just in terms of what has just happened in the markets. For those of you looking at euro dollar now, we are really testing that 134 level after a stronger than expected ZEW, German ZEW. So we always like, the markets, or the euro always tends to like a nice bit of strong German data, and that's what it got today. Just bear with me one moment. I'm just literally live tweeting as we talk. Great. And you should be able to see my desktop right now. I'm going to just pull up another chart really quickly. This is the Aussie monthly chart, actually, so it's a very long-term chart, which I'll talk more about later. But let's just start with that euro. Sorry, that's a very long-term chart. Let's go back to daily. As you can see here, this just has my my moving averages on it as well. And we've really shot higher today. I mean, that's looking like quite a very healthy kind of return to the uptrend. Remember, we had a little bit of a squeeze here. I think if you were to really look at this, what this red candlestick here shows, it's a little bit of a hammer pattern really, with the market trying to find a bottom. So it's got a long lower shadow, but it's still got a series. We've still got a series basically of higher highs and higher lows. So what we're seeing is that we're moving high. Obviously, in that situation, that's called an uptrend, and we're still very much in there. Just looking at it from the shorter term perspective, it's been a little bit choppier. We have certainly been very sticky around that 134 level, and you could argue, you could see a little bit of a rectangle pattern there. Let's just draw that in. Oh, I better get rid of that. Let me draw my horizontal lines. So there we go. Roughly, it's not a perfect rectangle pattern, but as you can see, it does look like we've pushed off from the outside. So the last couple of days, we've been very indecisive in euro dollar. We traded pretty much in that range, 133 on the downside, about 133.60 on the upside, and we really have seen it just push through there, and that's been a result of a couple of things. The dollar is slowly starting to weaken today after a better pickup earlier this week, largely on the back of actually the Swissy is really losing ground against the Swissy. Jano, do I expect this euro rally? Will it retrace? I think that's what your question is. I'll talk about that in one moment. But basically, I think, you know, what we're looking at now is that if we can get above 134, I do actually tend to think that we're going to be in some quite difficult territory, because there isn't too much in the way of that in 135. Now, 135 is actually a psychologically significant level. You know, those numbers that go up in fives do tend to be, for want of any better reason. But it's also possibly a level where the ECB will start to get very nervous. So around about 130... When the euro was rallying at this level, if we manage to sustain gains above 134 this time, then I think we're going to be at risk from that retracing that you said, because I think someone in the ECB, I think there's a chance then that the ECB will come out and they will sound very, very concerned. They're going to sound concerned about they're going to sound concerned about, you know, the impact of a strong euro on growth. There's a big focus now on growth, remember, and especially in the peripheries, on their export competitiveness, that type of thing. Even Germany hasn't been unscathed on that side of things. So I think we could just see the ECB come in and try and talk down the currency. Remember, they're very good at that. That's what happened here. That was Draghi back in February. He managed to talk down the currency pretty well. But since then, we've had a nice push higher. In fact, if we just look at it even from a fib level, there could be some significance here. I mean, you know, we've already gone through the 61.8, which was around about 133.20, so that is quite a bullish level. But I'd say that if we were to get a pullback, we might pull back to that fib level, so that 61.8% retracement level of that down move from February to April. That comes in around about, say, 133.20. So I wouldn't be surprised if we did get some sort of, you know, especially if the euro, if we do get some ECB speakers coming up this week who do start to sound concerned about the strength of the euro, maybe even some government officials. Remember, France has said that they're concerned in the past as well, and if we do get that, then the natural pullback area will be 133.17. I mean, the other thing I'd point out as well, this is the RSI chart below here, that is starting to move towards oversold territory, so around about 70 in that. Obviously, 80 is when you really get into the kind of the oversold zone, so we're not quite there yet. We could still have further to go. Anything above 50 is kind of a bullish It means that there's a bullish bias in that market, but just beware about the market starting to look a bit stretched. The market, when we say the market's starting to look a bit stretched, it does look really like the euro might pull away from the fundamental backdrop, which is not that fantastic. Certainly not from a growth perspective. But since the focus is all on the Fed, I think regarding of whether or not the timing of some sort of pullback could be dependent on what comes out of the Federal Reserve when they meet, obviously in tomorrow, when they conclude their meeting, and we get that Bernanke press conference at 7:30 London time. I think that's going to be absolutely pivotal. I think we're going to have a lot to chat about now. So you like draw fibs in general, not absolute tops. Well, because what I prefer to do is usually look at fibs on the close, and rather than put in the shadows. So draw them from the kind of top of the candle to the bottom in this case. I maybe a smidge out here, but not by much. Fibs, because people do draw kind of certain different lines, it's around a bit. They're kind of, don't use the exact figure. It's a bit of an art, but I wouldn't go from the top of that shadow to the bottom of that one, purely because I don't know if there was something that happened on that day that caused a long upper shadow. It could have been just, a fat finger mistake. So I'd rather just do it from the daily highs and lows. So as I said, there's definitely a potential for retracement there. We're not quite, but maybe not quite yet. We could still have a bit further to go. So on the upside, obviously, kind of 134.20, 134.60 as well. They were quite big numbers, but Rocco now brings me on to obviously the question that I'm sure a lot of people have been asking. Is there any real chance that Bernanke doesn't announce tapering? Well, that's an interesting way of looking at it, right? Because everyone's been going the other way, that there is going to be this chat about tapering. Ray, good point that there could be some sell orders around barrier option at 134. Usually there are around those big numbers. There's definitely a barrier option of selling activity around 135. That would be a very, very big level. But 134, those whole numbers do tend to have barrier options with them. In fact, you can read from so many different sources barrier options, every 3 or 4 times a day. Whether or not they're true or not, or people just say it, I don't know. But it would not surprise me. Any type of whole number usually has some sort of barrier option activity tied to it. I think you can also, I'd say 135 for sure. We know that's for sure that's going to happen. So they could be very sticky around 134, 135. Good point. So going back to Rocco's point, Bernanke doesn't announce tapering. I don't think he's going to say that they're going to taper. I don't think they're going to start at tomorrow's meeting. But really, that's not what everyone's looking for, is it? What everyone's looking for really is, or what everyone is looking for is actually what they signal, whether or not when they will actually start tapering. So we think it's more likely to happen in September, the September meetings, than it is in I don't quite understand what you mean, Rocco, by saying 45k to 65k. I think if they were to taper, I don't see them doing it tomorrow. I think that would be a big shock for the market. If they did actually start slowing down their purchases, maybe by, say, 10 billion a month, or potentially, less than that or slightly more, even a mild tapering, I think, would cause the markets to go crazy. We could see a big crash off in stocks that may take the dollar down with it, but we could also see just a big overall bout of risk aversion. I don't think that's affected at all. We are actually looking for them to start enacting it in September. But what the markets wants to know, they want certainty around what to expect. Right now, in the Financial Times, what they're saying is that they will definitely say that they're close to tapering, but it will be dependent on economic data. Well, really, that leaves us in the same position that we've been in anyway, largely because they've always said that the pace of, changing their monetary policy strategy will be dependent on economic data. What we'll be looking from then is whether or not they actually say, well, actually, these are the economic indicators we want. If we see another, 2 month or 1 month's worth of very good, initial jobless claims, for example, or, if inflation just picks up by an extra 0.3%, then that's what we're going to do. We want detail. If the Fed doesn't give us detail, we could see another bout of risk aversion. So if they don't taper and they don't give us detail, they just say, yep, it will happen. I see that as being a bit of risk aversion. But I think Bernanke's job tomorrow is two things. Number one, to calm the markets. Number two, to take control of the dialogue, of the conversation, of the narrative, if you like, of tapering, so that what we have is we have a central bank who has a huge weight of responsibility on their shoulders, and what they should be doing is actually, they're saying, we're going to do this carefully. We're going to sell XYZ amount after we reach XYZ targets, and then it'll be very easy for the market to figure out. So that's going to be really key there, and that brings me on to the next chart, because I know obviously this is visual and you don't just want to hear me whittering away. I don't want to hear me whittering away either, really. So as you can see here, this is the dollar index. So I'm going to just create a bit of a chart just to show you something, because there's been some funny old things going on in the markets in the last week. So basically, since we met last week, there's been a load of volatility in the market, and I'm sure those of you know, obviously dollar yen has been where that volatility has been, but we've also seen it in the bond market. For example, 10-year treasury yields, which we'll see in a moment. 10-year treasury yields, the orange line in the chart, they have been moving higher and higher. They had a big spike higher last week, the beginning of last week, and then they dropped off quite dramatically as we got some out of risk. But what we've really seen is that at first the relationship between treasury and the dollar, well, they both moved higher together, but then around about towards the end of May, that started thanks, Ray. Around about the latter part of May, we started to see this divergence. So as you can see, yields moving higher, dollar selling off very, very sharply. If I was to put another line on this chart, I could put it next to maybe something like the Nikkei or the S&P 500, because the dollar has been moving with stocks, not with the dollar index. Not with bonds. So what we're seeing here, we've seen a huge retracement. I mean, let's just measure that here together. So even just from that Jan 1st low all the way up to that high from when is that? That was the high. Oh, go away. The high from the mid-May or whatever, towards the end of May. I mean, that's a huge. We got through the 61.8. Now we're heading towards we're virtually almost pretty much there in terms of retracing our these price movements. Now, what we've seen in the past is that they do tend to move together pretty closely, by and large, but sometimes there have been noticeable exceptions when they have moved dramatically in the other direction, and that largely does come about as a result of something to do with quantitative easing. The first time, obviously, this goes all the way back to kind of last year, as they were thinking about kind of they were kind of on the way out with their Operation Twist program was ongoing, but they were thinking about changing it. So the dollar index move higher, and treasury yields fall much lower. So at this point they were also moving in opposite directions. Likewise for a while here, and then they kind of started moving in the general same direction. So the correlation isn't fantastic between the dollar and yields, which I think is a good point. But the thing I want you to take away is that yields can move high. The way that the dollar reacts to things like the end of QE, from what it has done in the past, let's just stretch chart a bit, is not always been clear cut. For example, just concentrating on the white line, which is the dollar index, we had, the dollar obviously, it has been negative as we've been talking about the end of QE. So, for example, in September, around about August time in the FOMC, and that could sell off in the dollar. And then we kind of moved higher, when they started doing QE, and then we continued to sell off. So even though you think that stronger yields should equate to a stronger dollar, they don't always, and it hasn't. don't know in a long-term perspective, you see, it's kind of interesting, really. Over the last 5 years, and we're not near the highs we've been, but we haven't. There is very little direction there, which shows that QE doesn't really cause things to move one way or the other. So even though we believe that stronger yields, especially if we can get kind of towards maybe, above 2.5%, maybe even towards kind of 3% in the next, say 3 months, that should be dollar positive. It's not given. And you don't say that with any degree of certainty, because now, I have looked, and I want to look at the pound. It's an interesting week for a couple of weeks. The pound is not fantastic. We obviously broke above 156 last week, but we are getting really stuck at this level here, this 157 level. Now, one thing I would say about the pound is that it respects its levels. As you can see here, on the way down, it kind of, hesitated for a couple of weeks around 158. Around all these big levels, 150 obviously was a massive level. We've got through a few others, but even kind of 150, getting through 156 was a little bit of a hassle. So it's no surprise really that we're moving sideways here. However, we are seeing just a little bit of weakness now creeping in, around about this kind of 156. Around about this 150, just below the 157 level. So as you can see, 156.95 is this 200-day moving average. That is still massive resistance, because if we get above there, it really opens the way to 160, which is of course a psychologically important level. So what we're seeing here is the market really is a big bout of indecision. Now I just want to stretch that a little bit. Kind of a bearish engulfing there, just about. You could probably get away with it. And we've got these kind of slightly longer upper wick suggest that the market is maybe putting in a bit of a top here. Now I'm not, I think it's very difficult to call tops or bottoms in anything at the moment before this Fed meeting. But one thing I would say is that the pound is looking, in the very short term anyway, fairly weak as we lead up to the FOMC meeting, which is interesting. And one of the reasons why is because of this. Sterling Swissy. Sterling Swissy has taken a right dive. The Swissy has really started doing well. Today it's really kind of getting its groove back. I don't believe there's too much driving that. Just bear with me one moment. We do have an SMB meeting, but that's not coming out. That's on Thursday. So we get that on the 20th at 8:30. And let me just check the headlines to see if anything's come out, because we really have seen it. It's really been massive. Not really. It seems it could just be, obviously maybe slightly fueled by Draghi. Earlier today he said that, he touted the prospect that there could be, some non-standard measures, which basically means things like cutting the deposit rate, etc., which has really pushed down Euro Swissy. As you can see, it's pushed down it's really had a positive impact on all of the Swissy crosses. So we've seen Sterling Swissy really fall off as well. It's now testing this 143.90 level, massive level, because if we get below there, it opens the way to 142. Very, very kind of short, and also lows from April, around about kind of end of April, opens up those lows. So what we're really seeing is some significant moves in the Swissy. This as well, you can see it with dollar Swissy as well, the US dollar and Swissy. Jano, I will talk about gold and oil, just bear with me one moment. As you can see, got through that 92 level. It was quite bearish. We have been down here before, and a lot of suggest trying to make a bottom. There could be some buyers coming in around about 91.30 to 50. So do watch out for that there. But we are, we've had quite a violent move in the Swissy this morning. The other thing that I'm going to look at before I look at gold and oil is obviously when you talk about the Fed and Rocco, this may come back to you. You've got to talk about the yen. So what we're really seeing is some real mixed markets at the moment, because what we're seeing today is the Swissy rise which is considered a safe haven, yet the yen has not risen. The yen has fallen, and suggests this isn't necessarily a safe haven move. It could just be a Swissy specific move. So what we're seeing as well here is the yen. The yen push higher. So again, comfortably 95. Let me just put it on a 10-day chart just to show you where this kind of moves. I mean, as you can see, you know, we're still, you know, within quite a tight range, but we are getting close to the kind of the top of our range. 95.70 we expect to act as fairly good resistance, certainly in the short term. Let me pull up my other chart. This is the daily chart, as you can see, on the hourly. Again, just kind of pushing higher quite nicely. Suggests that we've got a bottom in there now at 94.20 to 50. And, you know, around about 95.50, that's going to be the near-term resistance. If we can get above there, then it opens the way, really, for a move back to kind of 97 in kind of the, you know, the next 24 hours. So do watch out for that. But it does seem like dollar yen certainly on the move as we wait for the FOMC. So remember, you know, the dollar, you know, dollar yen should move higher as long as the Fed, if it mentions mild tapering and seems to do a good job of that, that should be dollar yen positive. But if they do anything to spook the markets, then that could be dollar yen negative, because obviously the yen is a safe haven. So you do have to watch out for that, but it should be quite volatile. It does tend to move with bond yields, but it hasn't fantastically at the moment. Dollar yen, I would actually say it's shifted from being, you know, a pair that moves with bond yields to a pair that moves with stock markets as well. So if stock markets are kind of mildly higher, that's fairly good news. But do watch out for, you know, some hefty resistance that we're coming up to, 94.20 in the very short term, and then 94.50 to 70. Okay, Jana, you've waited very patiently for gold. Let's take a quick look at gold. As you can see, gold, but it's trading in a range of the last few days. 13 kind of, you know, 70 has capped the downside, with kind of 13.95 capping the upside. So trading in quite a tight range. Obviously, if the Fed do decide that they are, you know, putting their tapering strategy out there for the market to see, and that should also be gold negative, because remember, people tend to buy gold when there is QE and an inflationary impulse. When there's not an inflationary impulse, they don't tend to buy gold. So what we see today, though, we've got some really key data coming out of the US at 1:30. That will be CPI for May. If we see a decline in CPI, right now the market expects a fairly healthy increase of about 0.2% on the month. But we're still expected to see inflation fall below the target rate, the Fed's kind of, you know, explicit target rate at 2%. So they still remain around about 1.4% for the headline rate. That could potentially be mildly gold positive, but as I said, like, you know, you've got this cluster of hourly SMAs, moving averages here, around about 13.85 to 87. Oh, let me just get rid of that, which could thwart the bulls. And then, of course, 13.90 as well, which, as I said, is like, you know, the top of this medium-term range. It does look, just in the short term, like we may have, you know, maybe finding a bit of a base just ahead of 13.75 before we start moving higher. Now, looking at just slightly stretching out that time frame again, the one thing I'd point out, there could be a potential. You know, we are at a pivotal level. If we can stay kind of above this 13.75-ish level, then we could, you know, potentially kind of move back higher. Then potentially there is a chance that we could test, you know, two levels of resistance. Obviously, there's this level of resistance that I mentioned at this kind of 13.90 level, and then above there, 13, around about kind of 14.25. 14.15 to 14.25. You know, we do have a bit of it. As long as we don't stay below here, then we still have, you know, this kind of series of higher lows, which suggests that maybe we put in a more meaningful bottom. Now, I'm also going to just add in my MACD just quickly. Yeah, I mean, you know, momentum does seem to be mildly higher, but I do think that gold is certainly going to be the one to watch tomorrow, because, you know, signs of an inflationary impulse, or the QE is going to last longer than expected, could really see gold maybe even get back up to 14.50, maybe even towards 14.70. However, if they were to decide to, you know, to tighten or taper, do a surprise amount of tapering, or sound like they're very committed to tapering, you know, in the next kind of 3 months, then we could easily see a sharp decline back to those 13.20 lows from April. Okay, oil as well. Oil's been a big mover. Well done for bringing that up. And oil's been kind of doing pretty well, and had it very well actually, and has actually picked up, especially compared to some other commodities. So this is an oil-rated thing. Partly it's because of, and this is UK oil. We've also seen some big moves in WTI, which I'll show in a minute. So this is Brent crude oil. Partly because there's escalating tensions in Syria, in Turkey, and the fear is that could potentially disrupt some sort of Middle East production to start with, but also distribution of oil. The other thing that we're seeing here is, if the oil market is looking ahead, trying to predict things in the future, and then what we could see, of course, is expectations for a bit of a continued pickup in the economy, and that's also helping the oil price because they're looking further down the road. But 107.56, as you can see there, 100-day moving average, quite a key, very key support resistance level. Whereas for now, we're seeing 102 or just below 103 acting as very good support, which is the 50-day moving average. So what I'd say is that, I wouldn't be surprised if we range trade into the FOMC. Obviously, any type of, risk adverse reaction to the FOMC could weigh on the oil price. Until then, I really see us kind of moving sideways, trading sideways very much so. Let's take a look at WTI. WTI has definitely been more interesting. It's had a nice recovery. Really, it's been kind of trading in a bit of a mixed fashion the last kind of couple of weeks. But we've seen, gains certainly have been. Oh, sorry, that's the wrong chart. My apologies. I was going to say that doesn't look right. We've had a nice move, nice push higher, reached those highest levels that we haven't reached really since 2012, but we've backed away from them now. So just put up this chart here. As you can see, that to me looks a bit like a bit of a bearish reversal pattern up here. You've got the long lower shadow, the very short body, suggests that maybe the bulls have just lost control there as we head towards 100, which is certainly the short-term top for now. In terms of the low, we're currently trading at 97.50, and then there's very good support at 95. Remember, we were there last week, so not so far away. I mean, obviously 94.15, 92.30 are the 100. 93.80, 94.15 as well. Two key levels, big moving average levels. They're the key things. So it does look like the market is, maybe the oil traders, the oil bulls that help push us higher, are taking profits as backing away from that 100 level. So it doesn't look like there's enough oomph in the market right now to get us above 100. But a pullback towards 95 could attract some good buyers because essentially the fundamental backdrop hasn't changed. I do think, though, that people will be very nervous about putting on fresh positions ahead of the FOMC because there's a chance that they may do something completely different. So Gabriel's just asked me, do I believe in trading on Fridays? Well, yes, but there's two things about trading on Fridays. Number one, sometimes you can see a lot of squaring up, so a bit more erratic action than normal. There's some important data released on Fridays, like the non-farm payrolls, that can cause an awful lot of volatility and real whipsaw action. So you've got to be prepared for that and read up about it and know what's going on. The other thing that I would say is that, sometimes if you don't like holding positions on over the weekend, that's the other problem. Obviously, there is always a risk of holding a position over the weekend in case something happens and the market gaps higher or lower, as the case may be. So there are some risks to it, but it's perfectly, the markets are all open and all markets available. Okay, everyone, I'm happy to take one or two questions. I know I'm running over just slightly, but thank you for bearing with me. No problem, Russ and Gabriel, you're more than welcome. Thanks for joining. If there's any questions, let me know. Happy to take one or two, but I know we are running late, so what we'll do is we'll leave it for this week. Please do join us next week for more. I look forward to it. As always, your questions were great, and I will be back next Tuesday, so thank you very much, everybody. Bye-bye.